Market Drop, a weekly update on equity markets, an outlook for next week with Mr. Pankaj Pandey, Head of Research, ICICI Direct. Very good evening, Pankaj, and welcome to the show.
Hi, good evening, Nitu.
Pankaj, if you talk about the markets, they stayed volatile, but yet they are consolidating in a very narrow range as far as the Nifty is concerned. But stock-specific moves are clearly seen still in the markets. Now that the earnings seasons are over, what is your take on the Nifty? Will this consolidation range stay for some more time, or do you expect it to break on either sides as far as the market condition is concerned?
So I think there are some positives overall what we see in the market, especially Nifty. So one is Nifty has reclaimed their 20-day average during last week. And this has been sort of acting as a hurdle for the market for some time. And from a correction perspective, since COVID, what we have seen is that we've seen price-wise 9% kind of a correction, and that correction sort of lasting for 10 weeks. We already have seen about 8% kind of a correction and lasting for 10 weeks. And we are overall not seeing major weakness in the market, which is why our sense is that overall things are sort of looking better. Mid caps and small caps have done better this particular week. And I think global markets are also in a sort of a decent shape. Most of your global indices are also trading at a 20-day average. And domestically, I think volatility has sort of corrected. So we really do not see much of a pain areas. So our sense is that overall, with this kind of a setup, with Nifty holding 17,800 kind of a levels, and despite the fact that FIs have been sort of selling, the markets have not taken the kind of a beating. And so from that perspective, our sense is that Nifty is likely to head towards 18,200, 300 kind of a levels in the month of Feb. So overall, the setup looks positive. And I think the inflows are also sort of quite favorable. I mean, what we are seeing globally is that you have countries like say, Taiwan, which has seen inflows of $9 billion, Korea about $7 billion. And so these are the countries where we have seen maximum outflows. But in our country, despite overall outflow of about $16, $17 billion last year, the kind of outflow is hardly about 5,000 crores. So from that perspective, things are not that bad on the FI perspective. I think the good part is that the domestic inflows are quite intact. So we've seen the highest SIP inflow of about 13,800. But what happens is that you see redemptions also. So so for the period of say August to November last year, I mean, inflows were somewhere about 4,400 odd crores because despite higher SIPs, you had people booking profits and that sort of. But for the month of Jan, we have seen one of the highest overall inflows of 11,300 crores. And even December also, things have been better at 5,300 crores. So typically what happens that in a festive season or in a marriage season, people tend to sort of book profits and utilize that money for other purposes. But now I think the overall domestic liquidity is also sort of getting better. So our sense is that Nifty combination of this should help it to achieve 18,200 kind of a levels.
We had RBI policy this week, Pankaj, and we saw 25 bips hike once again, and inflation for FY24 being targeted at 5.4%, which is on a higher side, elevated side, though it is within the range of 2 to 6% that RBI has stipulated. What is that you see as far as the interest is concerned? Do you expect RBI to take a long pause after this front loading of 25 bips, or do you expect interest rate to still go higher in months to come?
So yes, RBI hike of 25 bips on repo was on market expectation, including ours. And I think they are sort of continuing to maintain their withdrawal of accommodation stance. I mean, it looks like that the current hike is more of a front loading what they have done, and they want to sort of stay cautious given the fact that a lot of bigger economies, especially US, are still sort of struggling with higher inflation. So which is why they are sort of keeping the monetary policy action quite calibrated and sort of. But when we see US Fed also, so they are also acknowledging that the previous hike has started to have an impact in terms of inflation being lower. So our sense is that in all likelihood, from whatever we could gather, the rate hikes cycle in India at least is behind us. So we would expect that there will be a long pause over the next few policy meetings. So particularly in this calendar year. So we expect a long pause going forward because inflation for next year also is largely not that sort of very high because this is the fourth consecutive year we are having a normal monsoon. The crop sowing has been sort of pretty healthy across major crops. So really do not
Right.
see major disruption unless crude oil does something ugly moment.
So what happens to interest rate sensitives, Pankaj? What will you do on autos? What will you do on real estate and FMCG space?
So up till now, what we have seen from a commentary perspective is that since our hike has been about 250 odd bips, so it hasn't really sort of had a bigger impact on the overall demand. And which is why when you sort of look at the top end of the market, I mean, be it UV segment in autos or any other sort of a higher discretionary consumption spending categories, all of them have sort of started to do well or have been sort of doing well and really not
Okay.
impacted. I think last 2 years people consume more of services. Now they are sort of consuming more of products. So which is why you see a healthy demand for these. And
Okay.
so that way, I think nothing major negative is what we see for some of these interest rate sensitive counters.
Earning season is more or less over now. We have few results left. So overall, for the Nifty companies, how was the earning season this time? Some disappointments, some outperformance.
Yeah. So overall Nifty results, I mean, 94% of the index, we have already seen these set of numbers. Numbers are slightly ahead of our estimate, so there is a 3% kind of outperformance. A positive surprise is definitely is from the banking because that is one space where clearly the earnings have been better than expectation. Then I think besides that, autos overall we've seen good gross margin expansion across OEM. So that is another segment which is sort of done well. But however, there are some segments like say capital goods, pharma, or FMCG, or oil and gas. I think all of them have sort of underperformed because there's some of them are still sort of sitting on high cost of inventory and margins are under pressure. So
Okay.
overall Nifty estimates are inching up marginally, but we are sort of maintaining our Nifty target of 21,500, which is 21
Okay.
times combined average of FY 24-25 earnings of 1,020. So from that perspective, overall earnings is not a big disappointment, and I don't think it is going to sort of be a dragger on the market performance.
Pankaj, you just said that you expect RBI to pause for long now after this 25 bips token hike once again. So, do you expect, banking space, which was because of the interest rate hike getting benefited, to really give off some of the gains and see more interest coming for NBFCs now?
So yes, relatively NBFCs are now looking better because what we have seen up till now is that a good amount of price performance as well as earning performance by banks. But for banks, our sense is that largely the expansion in spreads or NIMs is largely sort of panned out. Probably next quarter we might see some more expansion in net interest margins. But
Okay.
the deposit rates are expected to sort of catch up. So NIM is not going to sort of expand. Whereas for NBFCs, if you look at the challenge has been that the deposits cost has been higher for them, and which is why you haven't seen much of a increase in the NIMs for most of the NBFCs. But
Okay.
with I think interest rate cycle sort of nearing, and our sense is that NBFCs are slightly poised better compared to banks. However, I mean, structural issues don't remain in both. I mean, asset quality is good, advance growth is good. So that way, I think nothing changes. But NBFCs typically, our senses would have a upper hand. I mean, when you sort of look at companies like, say, HDFC, I mean, advance growth was, say, about 12 odd percent. There was 26% advance growth for Mahindra Financial Services. Bajaj Finance did about 27% kind of a AUM growth. But when you sort of look at margins, HDFC margins were range bound at 3.5%. Mahindra Financial Services, the NIM declined actually. So our
Okay.
sense is that NBFCs are looking better. So from that perspective, HDFC eventually people will get HDFC Bank shares. So that is sort of looking attractive. Then I think even M&M Finance is also sort of looking attractive to us. So NBFCs are relatively looking better compared to banks, given the fact there has been no price performance, and towards the end of the cycle, they are slightly paced better compared to banks.
Mhm, mhm. If we talk about the pharma space, it seems to be have been written off by market participants post COVID, because from last 2 years we are not seeing any kind of a major momentum in pharma space. As far as the pharma crams are concerned, we have correction of 20 to 40%. So, what is the sentiment currently prevailing for pharma crams, and what is expected from here?
So I think COVID beneficiary pharma was one segment which was throughout the beneficiary of COVID. And
Mhm.
that base effect is now having or posing difficulties for the entire sector. Now, coming to CRAMS, we
Right.
have seen companies like Divi's, Loras Labs, a lot of other players. So there, we have seen a correction of 20 to 40 odd percent. So one
Mhm.
thing is that there are multiple things which are sort of playing out. One is prior to COVID, CRAMS as a segment was doing exceptionally good. So be it gross block addition or in terms of margins, in terms of sales growth, 12 to 15% was a steady kind of a growth rate.
Mhm.
So that led to a pretty steady sort of numbers, and which is why it was captured in valuation. The other
Mhm.
aspect was that when COVID struck, a lot of these CRAMS players were at the behest of the innovators, were doing deployed 50% of their resources towards
Mhm.
COVID-related work. Now we all know
Mhm.
that COVID has sort of vanished from most of the parts of the global country. So that work has sort of dried up. Now,
Mhm.
innovators globally are now again resorting back to normal R&D levels, and subsequently, it will take few quarters before this normalization of R&D and the subsequent outsourcing of that work coming to Indian CRAMS, and which is why
Okay.
there is a lag of say 2, 3 quarters at least, and which is
Mhm.
why next 2, 3 quarters things are really not good. And we have seen one of segments like say, for example, DVs, I mean, which has been the steady performer last 15, 20 years. This stock has been 100 bagger. Margin profile has been very rock steady at 35, 40%.
Mhm.
This particular quarter, the margin had sort of come down to 24%. So one of the big shockers, even from a result perspective, and we have seen
Mhm.
negative reaction. So I think
Mhm.
our sense is that while the overall long-term outlook is positive, but I think next 2, 3 quarters, one needs to watch out for the normalization of things to sort of happen. If that happens,
Mhm.
our sense is
Okay.
that all these stocks will sort of come back, because this is one industry where you really do not change vendors, because again, if you have to switch to some other vendor, you will have to sort of do the entire value chain, and which is why it's a very sticky kind of
True.
a sort of a business to be into.
Mhm.
So that way,
Mhm.
I think that next 2, 3 quarters, one needs to be cautious.
Mhm. Mhm. For defense, there has been a marginal increase in outlay this time in the budget for FY24. Do you see that impacting the defense group listed entities and a slowdown in order flows?
So when you sort of look at budget, I mean, while the overall allocation has been hiked from say 7.5 lakh to say 10 lakh, but
Mhm.
for defense, the hike is only single digits, about 8.4 odd percent. So obviously,
Mhm.
it gives an impression that probably defense is a sort of a neglected area. But I think there's some things which are sort of changing. One is typically we've seen, while whatever be the allocation in the budget, overall
Mhm.
our defense capex has gone by or has increased by 10%.
Mhm.
Good part
Mhm.
is that now you're spending more on R&D. So out of this entire capex, a good portion, 4%, is allocated towards R&D. Now,
Okay.
we all know that the government has been focusing more on indigenization of platforms. So from that perspective, this kind of a higher R&D is actually a positive surprise.
Mhm.
And overall, I think our sense is that as and when we sort of do more of indigenization, as of now, the indigenization level is about 68%. So our sense is that this is going to sort of keep going higher. So we don't see any sort of a structural negative coming out from the budget, especially for
Mhm.
defense PSUs. I mean, they're sitting on
Mhm.
order book of 2.2 lakh crores. So they've got good
Okay.
visibility for the next 3, 4 years. What we like
Mhm.
the most is Hindustan Aeronautics Limited. Here,
Mhm.
the numbers were okay. So our target price is about 3,300. So one is
Mhm.
while the order book is 84,000 odd crores, you will have new aircraft which are sort of in pipeline for development. And that can sort of unleash a further pipeline of about 55,000 odd crores, which can get
Okay.
finalized in the next 1.5 years. So I think HL looks a lot more comfortable from an order inflow scenario. So which is why this is our preferred pick overall in the defense space.
And this stock has been the best performing stock for 2022 also. So now you expect it to do better in 2023. Pankaj, tell us something about the stocks which you expect should witness upgrade in earnings, in times to come, because some of the companies have really done well as far as the Q3 earnings are concerned.
Correct. So we have seen, say, for example, when you look at stocks where there has been a good earning upgrade, Tata Motors is one of them. I mean, one is we were expecting a loss of about closer to 1,000 odd crores. Actually, the profit came to about 3,000 odd crores. So you see a good delta. And now, when you sort of look at individual business-wise, whether it is CV, PV, or the JLR front, we've seen margin expansion across all the three categories. I think this is something which we haven't seen after a long period of time, and I think the JLR wholesale numbers are also turning out to be good. We are also quite hopeful that with China opening, so larger global growth for Tata Motors also will get addressed. So I think which is why we liked this company, and we have sort of rated it as a buy. I think Trent is one company which is sort of defying the kind of a slowdown what you see from some of the retailers. I mean, this is one company which has grown at 36% CAGR in the last 3 years. I mean, none of the retailers have grown by this similar proportion. And this is happening on the fact that their Zudio format, which used to contribute about 16% of their top line in FY22, in FY20, is now contributing about closer to 40 odd percent now, between 30 to 40 odd percent. Because Zudio is again a format where the ASPs or product prices are lower than 1,000 rupees. And that is one segment which has been impacted, or that is what has been the impact of inflation in some of these categories. So this company, despite being in the value segment format, is sort of doing exceptionally well. And they have been the most aggressive in terms of store opening. So, for example, in Zudio, I mean, their total store count is 326. They literally opened about 100 odd stores or 91 odd stores last year. So that way, I think they're quite aggressive, same store growth. So all parameters they're sort of doing very good. Only wish was that it was sort of available cheap. So it remains one of the most expensive stock. But I think the growth is something which is sort of continuing to sort of surprise positively. Now, there are some stocks which have been sort of really disappointed. So one is Page Industry, is always known for steady margins. This particular quarter, we have seen company reporting one of the lowest margins in the last 6 quarters. So the margin range used to be about 21, 22 odd percent. This quarter it was 16%. And this stock is trading at about 67, 68 times on a forward basis. So we had very little choice but to sort of downgrade the stock. Overall, the numbers were quite disappointing.
Now let's talk about the hidden gem. So, which is the stock that you are going to give us as a hidden gem this week?
So stock I'm going to sort of give is again not a new stock, but we continue to sort of like this stock, which is Indian Hotels. The target price is 390. I mean, one is we expect the hotel industry to sort of remain healthy in this calendar year also. When you sort of look at daily flyers, they are crossing 4 lakh. Then you have a good number of events lined up in this calendar year, ICC World Cup. Then I think in the budget also the government is focusing more of tourism focusing tourism as in a mission mode. And the other part is that while people might complain that the average room rates are higher by 20-25% compared to pre-COVID levels, and look at any hotel, it is the prices would be higher 20-25%. And it is a wrong expectation to have that these prices are going to come down. Because our sense is that what you are adding in terms of supply is only 3.5 to 4%. So out of the premium rooms of say 90,000, you are adding about 18,000, which clearly signifies the fact that these ARRs or room rates are expected to probably go up even further more higher. That is what our sense is. And which means that Indian Hotels came out with one of the best set of numbers last quarter. So our sense is that this might become a sort of a norm for a big player like this. And which is why our sense is that from FY22 levels, turnover will double, EBITDA will become 5 times, ROEs, which never used to be in double digits, will be in double digits. Company is largely sort of debt free, so which is why I feel it's an upcycle in the sector which is going to sort of sustain for a decent period of time till the time we don't see ample signs of supply coming in. So that is why I think, and we've seen decent bit of a correction in stock. So I think at current levels, it offers an upside of 21%.
So for upside at 21%, you have Indian hotels. You can buy it for a target of 390. So Pankaj, major events done. You had RBI policy, which was done this week. Earnings more or less over. So how will you play the market in coming week now? There are chances of crude searching. Do you expect that to happen?
Well, yes, crude is always one element very difficult to sort of predict because of the geopolitical events. But I think you have US inflation numbers expected. So 6.2 is what is expected. Last time it was 6.5%. So besides job data, inflation is another key data which market participants look at. If that sort of continues to downtrend, probably it will have a posture above both domestically and globally. So obviously, US inflation number is obviously one of the key numbers to sort of watch out for. But our sense is that markets are expected to sort of head higher towards 18,200, 300 kind of a levels. And we expect some short covering in banks because banks is one segment which hasn't really sort of performed. Earning-wise, they've been good. So I think despite all the sort of negatives, we haven't seen Nifty sort of reaching or going down significantly lower. So from that perspective, I think the bias should remain positive. And 18,200 or 300 is on the cards for this month.
Thank you so much, Pankaj, for being with us. Appreciate your time.
Thank you so much.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.